Hi, my name is Cassian Nuñez. I'm a financial planner, real estate investor, and mortgage loan originator. And today I'm going to be talking about the RINO Invest client meeting schedule. All right, let's jump in. So the client meeting schedule basically explains how many times we're going to be meeting with you on a regular basis throughout one calendar year. As we meet with you from quarter to quarter, we're going to be covering the 5 pillars of financial planning, being insurance, estate, tax, retirement, and investment. And we break down when throughout the calendar year we're going to be touching on these very important pillars. So in Q1, we have insurance. Insurance is critical, right? Because it's basically risk mitigation for all the different things that are going to be coming at you as you go through life. The first one we're going to be covering is life insurance, making sure that you have the right amount of life insurance through every stage and phase of life. So what does that mean? If you're 20 years old and you don't have any dependents, no one is depending on you or your income to support them, then the amount of life insurance you're going to need is significantly lower, right? Because in the event of your untimely demise, you will only need enough to cover burial expenses and any debts that you incurred from the point of taking on the debt to the time of your death. And so people sometimes have an idea that insurance, specifically life insurance, should be an investment. We do not hold that idea to be true. We believe that life insurance is just that, life insurance. It is a risk mitigation strategy. It is not a product or a service that should be used or misconstrued to be an investment. And so we're going to do a term life insurance policy, 20 or 30 years, with the appropriate amount of death benefit based on where you are. Like I said in the first example, if you're 20 and you have no dependents, the amount of life insurance is going to be significantly lower. As you turn 30 and you get married, you're going to increase the amount of life insurance, that death benefit, because now you have a spouse that may be depending on that income that you're making. In the event of your untimely demise, they have something that they can use to continue on their life. As you have kids, right, the amount of death benefit should be increasing as a consequence of having those children. And so those are some of the things that you need to be thinking about as you determine the amount of death benefit insurance. Then you have health insurance. That one's kind of self-explanatory. You look at your family medical history, you look at your own medical history, and you determine the types of health insurance that you're going to need. As things change throughout your life, the different type of health insurance that you're going to need may change as a consequence of that. And most people receive their health insurance from their employer. And so if your employer provides a certain level of health insurance, but you need another level of health insurance, then we need to go shopping for private health insurance to supplement what the employer is providing. So those are the two things that we're going to be talking about first. And then next, we got to talk about property insurance. Whether you're the owner of a property or you're a renter, you still need property insurance to make sure that all the valuables that you have in the home and the home itself, if you're the owner of the home, is insured. You have valuable personal property. So do you have nice watches, nice jewelry, expensive laptops or computer systems or anything of significant value, art, things like this? You should probably make sure that the insurance that you have on it is the appropriate amount and will cover whatever is being insured in the event of a loss. Next, you have auto insurance. That's a big one, right? We're starting to see auto insurance premiums skyrocket throughout the country. For various reasons. If you live in a state with a higher uninsured motorist rate, then your insurance rate is going to be a little bit higher to compensate for all those folks out there not doing the right thing. And so we have to make sure that we're looking at our auto insurance in terms of coverage and in terms of cost, at least annually, to make sure that we're getting the best bang for our buck and that we're covered for the most probable ways that we can lose money as a consequence of owning our car. The next is pet and umbrella. If you have a pet, you should probably have insurance to make sure that your four-legged friend is okay. If you don't have a pet, then it doesn't apply. And then umbrella insurance, that is the insurance that is used to cover all the other things that could happen that fall outside of one of these other policies. And so when you think about umbrella insurance, think about if you got into a car accident and you have 100, 300, 100. So the amount that the insurance company will pay you in the event of a collision, in the event of extreme medical bills, in the event that you are the cause of the accident, they'll pay the person that was harmed, up to $300,000. But that person needs $500,000. So it falls outside of the limitations of your insurance. That's when umbrella insurance kicks in to pay the additional $200,000 to the other party that was harmed. That's just one example. There are several examples where you could have property loss, where your primary insurance policy covers up to $1 million, but it's actually going to cost $1.4 million to repair and replace everything in your home. Umbrella insurance comes in to cover the delta between your insurance policy and how much it's actually going to cost you to be made whole. And so umbrella insurance is extremely important for those who have rental properties, for those who have multiple responsibilities to others, and for those who may have a higher risk of loss based on where they live in the country, based on their driving records, based on a whole host of things. So that's Q1. It's a lot that we're covering in Q1. It's about an hour meeting where we're just reviewing our policies and making sure that we're up to date. So as we move into Q2, we're going to be talking about estate planning. So here we're thinking wills, we're thinking trusts, we're thinking advanced healthcare directives. Everyone should have a will. Whether you think you have enough assets or not to place into your will is less relevant. You need to get into the practice of knowing where your belongings will go in the event of your death. And everyone's death is guaranteed. And so we need to make sure that we're practicing that muscle of, as we accumulate things, we know where those things are going. So every year, we will sit down together and we'll go through the will just to make sure that everything that we own is accounted for and has a beneficiary assigned to it, included in the will and recorded in the appropriate place. It's not enough just to create a will and then sign it and keep it in the safe. You need to get that notarized. You need to record it with the appropriate state court, and you need to send it to various other parties of interest. For example, if you're trying to leave your home to a beneficiary, your spouse, or not your spouse, because that's covered by a different law, but you're trying to leave it to a cousin or a friend or a business partner or something like that, you should record that will with your mortgage company, if there's still a mortgage on the property, definitely with the court of jurisdiction, the court of appropriate jurisdiction. That will should be in a bunch of different places to make sure in the event that you die, there are multiple parties that can say that this document signed by you, notarized, is appropriate and legitimate. All right. Trusts. Trusts are getting really, really big. I am a big proponent of having a trust because it's basically asset management. If you have several different assets, rental properties, you have brokerage accounts, you have valuable collectibles, maybe cars or baseball cards or something to that effect, you want to put that in your trust. And upon your untimely demise, you have a document that basically says these are the people who are going to receive these specific things. So trusts are very important for that reason, because you're avoiding probate with this document, this trust. It's also important to understand that there are a bunch of different kinds of trusts, revocable and irrevocable trusts. And with those, there are tax consequences. If you have a revocable versus an irrevocable trust, the IRS may look at that and say, well, you've placed these assets in the trust, but you still control them, and you're the beneficiary of all of the assets in the trust. And so for those reasons, we're still going to tax you. Other people use trusts to decrease their tax liability upon their demise. And so you just have to make sure that you have the right trust for the right situation. And so we'll go through all of that. We have a very comprehensive questionnaire, and we'll ask you all these different questions. What are the goals behind creating the trust to make sure that you have the right one? And then the last thing that we cover in this Q2 estate planning meeting is the Advanced Healthcare Directive. Do you have a DNR, do not resuscitate? If you find yourself in a vegetative state, who is responsible for making the decisions about your life? If you are incapacitated, these are very, ugly things, morbid things to think about, but it's important to think about them now while you do have control of your faculties and not create a situation where your loved ones are left guessing and hopefully not fighting over who is responsible for making the decision to provide care in the event that you aren't able to make that decision for yourself. And so those are the three things that we're covering in Q2 as we go through your estate planning. And then we move into Q3, tax planning. This usually is everyone's favorite quarter. This is everyone's favorite meeting because people love to save money on taxes. And as I like to tell people all the time, the tax code with its many thousands of pages is really a list of incentives. There isn't a large portion of the Internal Revenue Code that is punitive, meaning, if you have earned income, you will pay the 6 different tax brackets that we currently have, right? There's a very small portion of the IRC that is punitive. A majority of the Internal Revenue Code, the IRC, is a list of incentives. Farmers get subsidies. That is found in the IRC. Real estate investors get to take depreciation. That is found in the Internal Revenue Code. Employer-sponsored retirement vehicles, your 401k, your 403b, these numbers are pulled out of the Internal Revenue Code. And these are incentives that the government provides in order to influence a decision that they would like to see made by consumers, and citizens of the country, because they believe that that's going to be best for growth of the country. And so when I go through all the different things that are available to you based on your occupation, based on your investment asset class, we can start to really review not only all the deductions and credits that you're eligible for, but also what you should be doing moving forward in order to take advantage of new tax deductions and credits. And so Q3 tax planning is huge for that. Some of the documents we're going to need are your prior year W-2s if you still have earned income, your prior year 1040. We're going to be creating the new 1040. Even though we can't file it until Q1 of the following year, we need to start looking at what your tax liability will look like when you go to file in January or February. And so we'll talk about that in Q3. And we need to identify any 1099s that you might have. If you're a real estate investor, you're going to have 1099s. You're going to have property management companies sending you things. You're going to have vendors who may have visited any of your properties and you had to pay them a fee for whatever service they provided. You're going to need a 1099 to account for those things as we're filling out that Schedule E. I don't want to get into a bunch of specifics here because I'm just supposed to be explaining the meeting schedule, but Q3 tax planning, really, really big. Look forward to working with you on your tax planning if you decide to make the decision to become client. And then the last quarter, Q4, is where we talk about investment and retirement. And this is really where people associate the value of having a financial planner because they're always trying to grow their net worth, right? Which is what we all should be doing because we're all supposed to be pursuing financial independence so that we no longer have to trade our time for money. Not to be misconstrued with retirement. Just because we no longer have to trade our time for money doesn't mean that we won't. Some of us love what we do. I personally love what I do. And when I achieve my financial independence, I still intend to continue working because I love this profession so much, right? But I don't want to have to do it. I don't want to have to get up every single day, sometimes on weekends, and do X, Y, and Z thing. So if you find yourself in that situation where you enjoy what you do, but you don't want to have to do it, we're going to talk about how to get to financial independence in Q4. We're going to talk about the investments that you need to be making in order to get there. And we're going to talk about what the next phase of life looks like. You know, the label that is most commonly used is retirement. I heard on a podcast the other day, a financial planner say restylement, because you're basically restyling what your lifestyle looks like once you achieve financial independence. You're not really retiring if you don't want to, right? So those are the things that we're going to cover in Q4, investment and retirement. We're going to be looking at your securities portfolio. which is probably going to be your employer sponsored plan. It might also be a taxable brokerage account. We'll see. We're going to be looking at your real estate portfolio. If you become a client, we're big on real estate. We believe it's the number one asset class. And so you will have some real estate in your portfolio. We're going to be talking about your SMART goals. SMART is an acronym for specific, measurable, achievable, realistic, and time bound. And so every goal that we create, we're going to make sure that it's SMART, right? And that we have a plan to pursue whatever that goal is. And then, as I stated at the beginning of the explanation of Q4, financial independence. When are you going to achieve it? What's that date look like? And what does that number look like? And every single time that we meet in Q4, we're going to assess how much closer we are to achieving that number. And so that is what a year as a RINO looks like. That's what a year as a client of RINO Invest Wealth Management looks like. Q1, insurance. Q2, estate. Q3, tax. And then Q4 is investment and retirement. I hope this has been helpful. My name is Cassian Nuñez, signing off.
The RINO Invest and Cash In with Cassian YouTube channels are hosted by Cassian Nuñez. Cassian Nuñez is a financial planner with RINO Invest Wealth Management. RINO Invest Wealth Management is a registered investment advisory firm regulated by the Securities Division of the state of Georgia in accordance and compliance with the securities laws and regulations. RINO Invest Wealth Management does not render or offer to render personalized investment or tax advice through the RINO Invest and Cash In with Cash In YouTube channels. The information provided is for informational purposes only, may not be suitable for all investors, and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.